China's central bank is still buying gold, but some of China's biggest banks are now telling individual customers that certain gold trading doors are closing. That sounds like a contradiction, but it is actually the whole story. Industrial and Commercial Bank of China has told customers that from the end-of-day settlement on July 24, 2026, it will stop acting as an agent for individual precious metals bidding trades on the Shanghai Gold Exchange. This is not about someone walking into a shop to buy a gold bar, and it is not about a family buying a bracelet before a wedding. The notice covers contracts like OU 99.99, OU 100 grams, OU 99.95, PGC 30 grams, AUT plus D, MAUT plus D, AGT plus D, AUT plus N1, and AUT plus N2. Some are spot contracts, some are deferred contracts. And the deferred products are where the risk starts to look much less like ordinary gold ownership and much more like leverage trading. That distinction matters, because the lazy version of this story would be, China is banning gold. That is not what is happening. The sharper version is that China still wants gold inside the state balance sheet, but it does not want ordinary households using bank channels to turn gold volatility into a retail casino. Gold has become emotionally powerful in China. For years, the household wealth machine was property. Then property stopped behaving like a one-way bet. Equities have disappointed many investors. Deposit rates do not excite anyone. The yuan faces pressure whenever people worry about growth, capital flows, or the dollar. In that kind of environment, gold is no longer just a commodity. It becomes a place where private anxiety goes to hide. That is why this bank move is interesting. It is not simply a market update. It tells us something about how Beijing wants financial risk to be organized. The state can buy gold calmly and call it reserve diversification. A household can buy gold after seeing prices rise on social media, add margin, get caught in a violent reversal, and then blame the bank, the product, the regulator, and everyone else standing nearby. The timing is not random. Gold has been through a brutal move. After reaching record highs earlier this year, spot gold has fallen sharply, with reports saying it briefly moved below $4,000 an ounce and lost close to 30% from its peak near $5,600. When prices only rise, retail products look harmless. When prices gap down, the same products suddenly become a suitability problem, a margin problem, a customer complaint problem, and a political problem. This is where the Shanghai Gold Exchange detail matters. These bank channels allowed individual clients to participate in precious metals contracts through bank platforms. To a professional trader, terms like deferred settlement, margin, forced liquidation, and contract permissions are normal. To many retail investors, the word gold carries a completely different feeling. Gold sounds safe. Gold sounds ancient. Gold sounds like something your grandmother trusts more than your fund manager. But a gold contract with margin is not the same thing as a gold necklace in a drawer. ICBC's notice is very practical. Customers with existing positions are told to sell, close positions, take delivery, and withdraw remaining margin before the deadline. After trading permissions are closed, even selling, closing and withdrawing physical inventory may become restricted through those channels. This is not a soft marketing email saying the product will be adjusted later. It is a wind-down notice telling people to clean up their accounts. Other banks are moving in the same direction. Postal Savings Bank of China, Ping An Bank, and China Guangfa Bank have also taken steps to suspend, close, or prepare to exit similar agency services. Some banks have raised margin requirements dramatically, with reports saying some requirements have reached 140%. A margin requirement that high is not there to attract new customers. It is there to make the trade unattractive, difficult, or functionally impossible for anyone who should not be in it. The key question is why Chinese banks are doing this now, when gold still has a strong long-term strategic story. The answer is that there are two gold stories in China, and they should not be mixed together. There is official gold, held by the central bank. The People's Bank of China reported another 10-ton purchase in May, bringing official holdings to 2,332 tons, around 9% of total reserves. This is the gold story that fits geopolitics. It is about dollar risk, sanctions risk, reserve diversification, and the slow fragmentation of the global financial system. China does not need to say de-dollarization every day for everyone to understand the logic. If a country believes the dollar system can be used as a weapon, gold becomes attractive because nobody else's central bank can print it, freeze it, or settle it through a messaging system controlled by geopolitical rivals. Then there is retail gold. This is the gold bought by households who are nervous about property, nervous about stocks, nervous about currency depreciation, or simply chasing momentum after watching prices run. This gold demand can be rational, but it can also turn emotional very quickly. When the product is simple, Like physical gold or a lower risk accumulation plan, the risk is easier to understand. When the product has trading hours, contract rules, margin requirements, forced liquidation risk, and volatile international pricing, the household is no longer just saving in gold. It is speculating through a bank-distributed market structure. That is the line being drawn. China is not rejecting gold. China is rejecting the part of gold trading that can create retail blowups inside the banking system. This lesson has history behind it. In 2020, Bank of China's crude oil treasury product became a national embarrassment after WTI crude futures settled at negative prices. Retail investors who thought they were buying into an oil recovery trade ended up facing extraordinary losses, and Reuters reported at the time that investors complained the bank should have done more to protect them. That incident taught Chinese banks and regulators a very painful lesson. When a complex commodity-linked product is sold through a trusted bank channel, losses do not remain a private market event. They become a public trust event. Gold is not oil, and this is not the same product, but the institutional memory is obvious. Banks do not want to be caught again as the friendly-looking gateway that helped retail clients enter a market they did not fully understand. When a product is profitable, everyone says they made their own decision. When a product explodes, suddenly every risk disclosure becomes too small, every warning becomes too late, and every customer service script becomes evidence. This is why the move should be read as risk boundary management. Banks are not saying that precious metals have no future. They are saying that certain retail trading channels are no longer worth the trouble. The revenue from agency trading is not enough to justify the risk of complaints, regulatory pressure, and reputational damage when markets move violently. There is also a deeper domestic angle. In China, financial losses can become social stability problems when enough ordinary people are involved. That is different from a hedge fund losing money in London or New York. If sophisticated investors lose money, the state can say they knew the risks. If ordinary savers lose money through a product they accessed from a big state-linked bank, the line becomes blurrier. The public does not always distinguish between a bank selling a product, a bank distributing a product, and a bank merely providing a trading channel. The bank logo is enough to create trust. This is why the word individual in the ICBC notice is so important. The restriction is not aimed at China's strategic gold policy. It is aimed at individuals using these channels. The authorities are not trying to stop the state from owning gold. They are trying to stop households from turning a safe haven narrative into leveraged exposure. The World Gold Council's May data makes the contradiction even clearer. While the PBOC bought more gold, Chinese gold ETFs saw outflows after an 8-month inflow streak. Wholesale demand weakened, and gold withdrawals from the Shanghai Gold Exchange fell sharply. That means the market is no longer a simple story of everyone in China buying gold at the same time. Official demand is still there, but private demand is cooling or becoming more cautious. Banks are seeing that cooling and volatility in real time, and they are choosing to reduce the riskiest channel before the next accident happens. This also tells us something about the Chinese household balance sheet. Gold's popularity is not only about gold itself. It is about the lack of satisfying alternatives. When property feels damaged, stocks feel unreliable, and deposits feel dull, gold becomes one of the few assets that still has a story. It has a geopolitical story. It has an inflation story. It has a currency story. It has a cultural story. That makes it powerful, but it also makes it dangerous when the price stops cooperating. For Beijing, that emotional power is useful only up to a point. If households buy physical gold as long-term savings, that can be tolerated. If banks sell gold accumulation products that fit wealth management frameworks, that can be tolerated. If retail investors start treating gold contracts like a high-volatility trading game, the state sees a different problem. The same asset that symbolizes safety can become a channel for losses and anger. This is the real gold paradox in China. The state wants gold because it reduces vulnerability. Households want gold because they feel vulnerable. Those motives look similar from far away, but they are not the same. The state can absorb volatility because it is managing reserves across decades. Retail investors often cannot absorb volatility because they are managing savings, mortgages, business cash flow, and fear. That is why this story should not be read as bearish for gold in a simple way. Removing some leveraged retail access can reduce speculative heat. It can take away a layer of demand that was chasing price moves through bank channels. But it does not erase the strategic logic behind central bank gold buying. If anything, it separates the gold market into cleaner categories. Official gold remains part of the geopolitical reserve story. Retail leveraged gold becomes a risk control problem. Physical gold, accumulation products, and ETFs sit somewhere in the middle. For global markets, the message is subtle. China is not walking away from gold. It is trying to decide who should hold gold, how they should hold it, and through which channel. That is a very Chinese form of financial management. The asset can be encouraged in one pocket of the system and restricted in another. The state can buy more while banks tell individuals to close certain accounts. That is not hypocrisy. That is control. The bigger question is whether this becomes a template for other retail risk areas. China has already gone through property tightening, internet finance cleanup, wealth management product reform, and bank commodity product trauma. Each time the pattern is similar. A product or market becomes too popular, too leveraged, too emotionally loaded, or too politically sensitive. Then the system narrows the channel, before private risk turns into public anger. Gold now sits in that awkward position. It is still prestigious. It is still strategic. It is still a hedge. But because it has become a refuge for anxious money, it now carries social meaning beyond its market price. That is what makes this story worth watching. If more banks follow ICBC and fully wind down individual Shanghai Gold Exchange agency trading, it will confirm that this is not one bank making an isolated business decision. If margin requirements remain extremely high, it will show banks want to discourage participation without necessarily saying the word ban. If Chinese gold ETFs keep seeing outflows while the PBOC keeps buying, it will show the gap between state confidence and household caution. If physical gold sales remain strong, it will mean households still want gold, just not necessarily through risky trading contracts. The cleanest way to understand this is that China is not choosing between loving gold and hating gold. It is choosing between strategic gold and panic gold. Strategic gold belongs in reserves, where volatility can be managed quietly. Panic gold belongs in households, where volatility can turn into complaints, forced selling, and political discomfort. So when people say Chinese banks are suspending individual gold trading, the better question is not whether China has turned bearish on gold. The better question is why China is comfortable accumulating gold at the top level, while making it harder for ordinary people to speculate on it at the retail level. The answer is simple, but uncomfortable. Gold is useful to the state when it represents sovereignty. Gold is risky to the state when it becomes a mass market expression of fear. And right now, Chinese banks are making sure that fear does not come with margin.